understanding the global investment market can be quite a challenging task. Alex Cook, Chief Executive of GCI Wealth, joins Narina and myself about how to navigate these complex international markets. Alex, thanks for your time. Firstly, I'd like to do a bit of myth busting. A lot of times people hear of offshore investing and they think your returns are going to be astronomical. We're talking double digit here. Is this in fact true?
Can be, but it swings both ways.
Okay.
So, I mean, you would have noticed what happened in China recently. China has recently dropped by around 30%. The preceding 12 months, it's gone up by about 100%. So it really does go both ways. What you would look to is what the long-term average has been. And when we construct plans and asset liability models, we don't look for these massive returns. They may happen, but we don't bank on them. What we rather look to is outperforming a certain return objective. So you might decide that inflation plus, and I'm talking US inflation now, inflation plus 4 is satisfactory. That would fall into sort of a moderate risk profile type portfolio. US inflation is running at about 2%. So if you're outperforming 6% in US dollars, that's not bad. It's quite good. So yes and no. It can be great, but it's not always fantastic.
Definitely agree with that, and I think when you think in terms of international investments, you need to think in terms of two decisions that you're making there. The one is the actual asset that you're investing in offshore, and what is the return prospects for that particular asset. Also, what does that return profile look like? And then there's the second level, which is the currency. You always need to separate those two decisions. You can't make it one decision and say, I'm going offshore because I think the rand's going to weaken. That is probably the worst decision or basis for an investment decision offshore that you can make. It should first and foremost be about what diversification, what alternative type of exposures can I get in international markets that I can't get in my local market. Then comes the currency decision, and sometimes you might find that a very good investment proposition offshore might be counteracted by the currency view. You can then hedge out that currency and just get the pure investment performance, maybe in something like biotech in the US, for example, or whatever your view might be. Think of those two decisions as two separate decisions. Would you agree with that?
What you find is investors usually make the call on the rand at exactly the wrong time.
Yep.
I can tell you when the rand was trading at around 7 to the dollar, we were getting financial advisors and investors. They would not take money overseas, no matter how much we encourage and push them to. And now that the rand's trading at 12.40, we're getting calls on a daily basis. How do we take money overseas? And I'm not saying it's a bad idea. You still have a large investment opportunity overseas that you do not have here. We have 1% of the world capital here. Overseas, the other 99% is waiting for us as opportunity.
Alex, I want to touch on a particular point here. You said that there are more than 200,000 mutual funds globally. This is compared with around 1,000 collective investment schemes in South Africa. There's a lot to navigate.
Well, so locally, it's a bit of a minefield.
Yeah. So what do you do?
Locally, they're actually more unit trusts than there are investable shares. So, and it's a challenge locally. Overseas, it's even more of a challenge. So what you've got to do is have a very, very strict process where you filter down and take 200,000, rationalize that choice through qualitative and quantitative measures, and get to a shopping list where you can then put together a portfolio that makes sense. But it takes a lot of work, which is why we've upskilled our team, made the team more robust, and pulled in some top resources from large houses who have now joined our team. People like Greg Flash, who's our Chief Investment Officer, Alex Funk, Louis van Gas, also from PSG originally. So very good multi-managers to rationalize these choices, because it is complicated.
I think it doesn't have to be that complicated, of course. Because I think that if one, well, I think if your focus is 200,000 funds, that's difficult. If your focus is maybe as much as 30 or 40 global investment drivers and you implement them using ETFs, then it's a different ballgame altogether. And I think it's the approach of trying to evaluate funds and fund managers and investment management companies that makes it very complex. And I think one of my biggest concerns about following that sort of approach is that you are focusing on something which is not predictable. And I'm not talking about predictable in return, I'm talking about predictable in consistency. consistency of exposure and investment style. To keep tabs on 200,000 funds and fund managers, and in terms of their investment philosophy and their view on the market, makes it incredibly difficult from a distance to actually dictate or think what is actually my true exposure in the underlying market. Because you might invest in a fund because that fund manager might be very bullish on China, and you think that's the way I want to be, and before you know it, the fund manager has changed his view and he's now not bullish on China anymore, and you don't realize that you don't have the exposure in your portfolio anymore that you thought you had. With an ETF-based portfolio, you've got the persistency of that exposure and knowing with certainty what my exposures are, and then you can add individual fund managers to it.
Well, Alex, I'm going to give you an opportunity to answer to that, but also just very quickly, I'd like to know what the biggest concerns are currently globally. If you look at what's happening in different stock markets, looking at the economic environment, what are the biggest concerns? And of course,
there's so many large concerns. I mean, Greece is obviously top of everyone's mind. China's top of everyone's mind. I think these are probably minor issues compared to what's happening in the US, whether they're going to raise rates and how quickly that's going to happen. However, I think this is all just noise. I think what we need to focus on is constructing good portfolios. Constructing portfolios that have good diversity amongst fund managers with different styles. Fund managers with focus on different geographies. So get geographical diversity, style diversity, and the portfolio should be robust over time.
Thank you so much, Alex, for coming in. Alex Cook telling us how to navigate that very complex offshore market. And